Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday, August 31st, 5:18 p.m. Coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market continue to be in a correction, and boy, are we in a correction. Check over here at the trend gauge. Leaders still hanging in there. I think only about five are breaking the 21 from last week's leaders list, but the indices are a different story. Continued bear market action. You can see short term here. These three sections indicate where are the five major indexes relative to their moving averages. We've got a short-term indicator using the 21-day exponential moving average. All five are below their 20-day, 21-day moving average. Medium term, we've got three below the 50-day moving average. We've got the mid cap and small cap sitting right on the 50-day moving average. So that's neutral with the arrow pointing toward bearish. Long-term, after failing into the 200-day moving average a few weeks back, it's been nothing but downward momentum that has really picked up since Jay Powell's hawkish speech from Jackson Hole last Friday. So what happened today? August closed with a 4 straight down day since Powell's speech. Let's check the numbers here. G6, slight outperformance. This is our in-house composite of 6 growth ETFs, down 0.47% on the day. S&P down 0.8%. Now these indexes all gapped up this morning, and that is typical bear market action. You gap up in the morning, suck a few people in, and close weak. Typical bear market action. Open strong, close weak. See it a lot. Saw it yesterday too. We gapped up on the open and we're down more than 1% across the board on the indexes. Not quite as bad today, but same type action. Gap up, suck them in, hard reversal. S&P 500 down 0.8%, NASDAQ 100 down 0.6, Dow down 0.9, midcaps down 0.7, Russell down 0.6. Global diversified 60/40 stock and bond index. Bonds not doing their job. This is down 0.6% on the day as interest rates continue to tick higher. In-house, our flagship GROTECTION portfolio down just a fraction on the day, 0.02%. So let's get into what we do here at Revere. Let me describe it briefly, and then we'll get into some interesting charts, and we'll talk a little bit more about the state of the current market. So this is a chart of the S&P 500. Actually, this is a chart of the SPY. Let me bring up the S&P 500. And what we do is those 3 time frames and then also leadership that I mentioned on the trend gauge on the prior page, we compare where the indexes are to them. 75% of all stocks will follow what's going on with the overall market. So when we've got our short term green line moving average trending higher, our intermediate term 50-day moving average trending higher, and our long-term 200-day moving average trending higher, and they're all stacked short to medium to long, and the market's above it. Market's perfect. This is how we want it. Not a lot of reason to be fearful of what's going on in the market. You just get in, you monitor your positions, you get in the leading stocks and the leading sectors and ride that wave as long as it goes. But as we know, all waves come to an end when we start fading, and our stops will start getting hit, indexes will start rolling over, and we'll pull back a little bit on our exposure. If we start to really roll over like we saw here at the beginning of January, the slopes of the medium term and the intermediate term will roll over. Price will go below it, and then if we get below this black line, the 200-day moving average, we want to really be defensive, because you know what I'm going to show you, don't you? This is the chart of the last 13 bear markets. We hang our hat on the ability to dodge these severe bear markets, get our clients out of the way so that their nest egg that they've gathered while they're approaching retirement does not get decimated. I know it's hard to believe, but there are a bunch of advisors out there that are completely incapable of doing this. Call it unconscious incompetence, call it willful ignorance, whatever you want to. They're just going to stick with the indexes. That's what salespeople do. They sell you the product and then they move on to the next person to sell the product to. That's such nonsense. We've proven it here at Revere, we think, and the numbers back us up, especially these numbers. You do not want to get caught in a severe bear market. All of these severe bear markets occur under the 200-day moving average. That's the black line. If you take one rule away from what we do here at Revere, when the major indices are below the 200-day moving average and you get the heck out of the way, you will save yourself a lot of financial capital and mental capital, a lot of heartache, indigestion, you name it. We're pretty convinced that this is the way to go. We've been doing it for, I've been here 6 years now. Hey, Dan, where's my desk clock? I didn't get the catalog to pick out my gift. I'll bring that up on the podcast this weekend. So anyway, when you get under the 200-day moving average, then the next thing we're looking for is, hey, where do we want to re-enter? And we want to re-enter when we get back above the short-term 21-day exponential moving average. This usually corresponds with a few leading stocks or potential leading stocks starting to act well, and we'll see how far it takes us. Sometimes you only gain a couple of percent before you roll over again. No problem, you get right out. Dip a couple toes in the water when you get above the 21, but ideally you want the 21 to start sloping higher when you get in, and that's what happened right here on 7/15. We took a step back in. We rode this higher until we ran into this 200-day moving average. Now we've been lightening up over the last couple of weeks. We got a little bit more back in on this nice day last Thursday on 8/25. The next morning, Jerome Powell came out with his hawkish comments. The market sold off big time. We cut our risk by 75%. And now we've got 4 days down. This, for some reason, the fourth day is not showing on this chart, but it will show on the SPY chart. You can see the fourth day down here, second close below the 50-day moving average. Won't be long before the 50-day moving average flattens out and rolls over. And we're now 7.8% below the 200-day moving average. And stochastics in oversold, but they're still going lower. But let's talk when we get to the tail of the tape. We'll talk about overstaying your welcome on the short side and why we got out of our S&P 500 short today. But let's go through the rest of the indexes first. Here's the NASDAQ 100. Same situation, two closes below the 50-day moving average. Dow Jones Industrial Average. Here's the DIA ETF. Second close below the 50-day moving average. Mid caps, MDY. Nobody talks about mid caps. We do here at Revere. This is the incubator for the next leaders as they grow into S&P 500 quality and size stocks, sitting right on the 50-day moving average. IWM, small caps, again, sitting right on the 50-day moving average. All of the stochastics pretty much mirror each other. Oversold, but not starting to hook up. This is the next thing that you want to look for, is for them, first of all, to stop going down and then hook higher and then get off of oversold. That's this 20 level here. And you really want to wait until the blue line, that is the moving average, till that gets back above 20. Sometimes just you'll poke above the black line. We'll just poke above for a day or two, but until the moving average gets behind it, that's when you see or you're more likely to see more momentum higher. But for right now, when this rolled over, doing what it does, markets rolling over. It happened here, it happened here, it happened here, it happened here, it happened here. You just can't ignore these things. They're fairly reliable indicators, and they go from oversold to overbought, and it's best that you pay attention to them. So those are the 4 or the 5 major indexes. So let's bring up the tail of the tape now. Oh, by the way, if you're interested in an approach like this, as I just described it on the S&P 500, reach out to me. Don at RevereAsset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Common sense approach to your investments. What other aspect of your life, when it starts going south, don't you take corrective action? I'm guessing if you're a reasonable human being, you don't just ignore problems. So anyway, let's get to the tail of the tape here. Let me bring this up. And things have just continued to go from bad to worse. All of these indicators, in addition to the headwinds, negative. Put call at 1.11, not really escalated. VIX at 26. This thing was actually down today while the indexes closed at their lows of the day. Strange reaction from the VIX. Fear and greed is at a 48. We're operating under this bear case with the rally failure in the break of the 21-day exponential moving average on 826. Some news today. Loretta Mester, she's on the Fed. Fed people like to flap their jaws. She said, no rate cut next year. We need to see real interest rates positive. Right? Real interest rates are the nominal rate minus inflation, and right now that's a negative number because inflation is higher than the nominal rate. So she wants to see the nominal rate above inflation. So they appear to be very serious about slowing the economy to get on top of inflation. I don't blame them. I know there's going to be pain, as they've said, but inflation is what ruins civilizations, quite literally. It has. Out of control hyperinflation can ruin a civilization, cause civil unrest. You got to get it under control. More news, ADP report weak, job openings negative 100,000 versus expectations. That's actually bullish from a contrarian standpoint. Any slowdown in employment would reduce wage inflation, which would bring down overall inflation. This ADP report isn't as heavily relied upon as the numbers from the government report, which comes out Friday before the open. And I had this note here, kind of what I said in the introduction. Today was just like yesterday, typical bear market action. Open strong, close weak. So expectations were both negative and neutral coming into today. Negative because we broke the 50-day moving average yesterday. Neutral because we had 3 days down already, but we continued more negative, further below the 50-day moving average. And now we're at our 4th day down. On both the S&P and the NASDAQ 100, we went into resistance and failed. Sectors today, TAN, so the solar ETF was strong, biotech strong, and KWeb strong. Oil started out weak, got a little bit stronger. Producers ended up positive. Some things started out positive and got worse, like cloud stocks, and they're going to be worse tomorrow because of some after earnings reports. The dollar actually started strong and got weaker, but it didn't keep the indexes propped up. Bonds were negative today, which means interest rates going higher. Fertilizers weak again, retail weak, and semiconductors weak. Some stocks that we were keeping our eye on coming into today. We'll take a look at those charts momentarily, but let's talk about what we did with the portfolio before I go to the bottom line. The bottom line is 4th consecutive day down since the Powell speech. Bears firmly in charge. So we sold SPX today. Why? When we're below the 50-day moving average, below the 21, below the 200, would we be taking off what is acting as a hedge against our 4 longs? Well, we've still got 85% cash. Our adjusted beta after this is 0.29, which is 30% of what the S&P 500 would do. But most of it is oil and 2 small positions in growth stocks. Oil does not correspond to the S&P. In fact, it's the least in sync with what the S&P does. So although we got to put a number on it, Michael's actually working on some correlations that might help us refine this number. So why did we sell our SPX? Well, let's take a look at this chart here. I thought that this was a very interesting visual representation of the rolling 3-day returns of the S&P 500. I already mentioned how coming into today, we already had 3 days down. You don't want to look at piling on shorts when you're already down for 3 days. Yeah, yes, I understand you can go down quite a bit more. Yes, I can understand that you can overshoot all the time, but we're talking about an odds favor situation here, and you can kind of see the average when you get above 2%. Geez, my knees, stop already. When you get above 2% on a rolling 3-day period, you're kind of really getting very short-term overbought. When you get below minus 2%, you're getting very short-term oversold on this 3-day. We're all the way down here. I had been thinking about, when should I take this off? I hate to overstay my welcome on the short side, because when you're making money on the short side and the market's going down, you're really making double what it is, because you're going opposite of what the market's going. So market down 1%, you up 1% means you're really gaining 2% or double. Same situation is the opposite. If you're short and you're going lower while the market's going higher, you're losing twice as much. So I'm always quick to get out of shorts when they're oversold. And how do you know when they're oversold? Well, first of all, looking at this chart, cemented it this morning. This already had been something I was thinking about. And then today I saw the hexafecta on stochastics for the S&P 500. What the heck is the hexafecta, you might ask? Well, MarketSmith gives us 6 intraday charts available, all with the stochastic. So this is kind of rare, but when you see all 6 buried on oversold, the odds are you're looking at a bounce, especially when on the 60-minute you've been oversold for 2 to 3 days. You can tell even during these pullbacks that we didn't stay oversold for more than 2 to 3 days. So it's their 3rd day oversold, corresponding with this. Now let's just tick our way backwards. We're still oversold. We got oversold late afternoon on the 30-minute also. We were also oversold on the 15-minute. We were also oversold on the 10-minute. We were also oversold on the 5-minute. Was this area in here, and we were also oversold on the 1-minute. It happened twice this afternoon. It happened here and it happened here, and both times we took a little bit. We took half off the SPXS here, here and here, I believe it was, and then we bounced. We're already out of it, but then we sold off, so maybe we would have had another shot going into the end of the day. But no, we wouldn't have, because look, we didn't get the last oversold on the 5-minute chart. So 6 time frames in addition to daily, all oversold. We booked an 11 to 12% profit on SPXS. I'll take that. And we're going to bounce. We always bounce. It's what bear markets do. The bounces are quick. They're severe. They suck people in. But we're 4 days down now. Tomorrow will be our 8th day down on the 8-day exponential EMA, since it rolled over. And then we can start gauging how extended we are from there. And we're already pretty extended from the ADMA there. So I thought the time to get out was good. We've got minimal exposure left in the market. We've got 6%. Let's take a look at our remaining portfolio. We've got 6% left in LNG, which has undercut and reclaimed the 21-day moving average twice in the last 2 days. Oil's gapped down today, recovered most of it. Exxon undercut and recover of the 21-day exponential moving average. We've got a 3% size in that, and 2% positions in growth stocks. Shockwave continues to act well, consolidating near the highs after this beautiful gap up on earnings. And also Wolf, same situation, consolidating after this nice gap up on earnings. So our risk is kind of minimal. Oversold on the indexes. If we break the lows of today on some of these, we'll be out of them, and that means the market's even weaker than it appears. Let's go back to the tail of the tape, and so that's what we have left. Let's take a look at support and resistance levels. The next level down is this 3,900 to 3,920. This has been a battleground area for May, June, and July support and resistance. So we'll see what happens should we get down to there, less than 2% away from there, from that support area. And all of these areas above, we've just failed one by one. Starting up here on 822, it's really been an ugly last 9 sessions in the market. Let's take a look at the stocks that I had on the focus list coming into today. And we'll start off with LTHM. These are in the 21 over 21 list because that's the best of the best. And this is a nice consolidation right on the top of this breakout area from this cup and handle. Now, the market is not in the situation where I'd be going heavy into everything or anything. But we do want to point out what the best setups are, because if the market environment changes, and remember, we're only ever at most 4 days away from a follow-through day, which would bring leadership back into focus in the markets, never more than 4 days away from possibly re-entering the market. So we always want to keep our list fresh. So LTHM, CEG, tight up here at the pivot plus 20% area. Maybe a 3 weeks tight, maybe you already had it. Still trending above the 21-day, obviously. I wouldn't even be looking at it if it wasn't. Oxy, leading oil stock, Warren Buffett's favorite oil stock. He's not bad at investing. It's pulled back nicely after this big move up, when this was the day when he was given approval to buy up to 50% of the company. And we're back actually inside that high volume day, which is normally a spot for support. This is, I know we already own 2 oils, but this is at the top of my list to put a small percentage into, maybe at the expense of one of the other ones, just to diversify a little bit, or also to replace the half of Exxon that we sold yesterday. So Oxy, CMG was a third one. Not a good day for CMG. Actually, it closed below the 21. I liked how volume was drying up here on this nice cup and handle, and it had what I always look at, what I always look for, high volume gap up on earnings, and a continued move higher. It's getting into oversold here. I have a feeling I'll be buying some CMG at some point in the future, just not ready for it yet. GFS, this had a nice day yesterday when pretty much everything else was red, consolidating nice tightly here along the 21. Again, another one that had a good reaction to earnings. CCJ, uranium, big move up in uranium with all the talk about, hey, we need nuclear power. Finally, I guess people are getting over their fear, considering that, look at those big volume bars, considering that is absolutely the cleanest available. I know people are scared, but there have been a lot of technological advances in uranium that should prevent some of the actions that we've seen in the past. First Solar continues to be extremely strong, just riding this 80 EMA higher. They announced that they're building a plant that's going to be, they're not going to have to pay much for it at all, because it's being subsidized by the government as part of this last Inflation Reduction Act that was passed. Again, look at the volume on First Solar, actually acting better than Enphase, which was first out of the gate. And finally, TBT, this goes up when interest rates go up, has been consolidating, nice little cup and handle here. So those were the 7 that I was looking at coming into today, 7 closest charts. Give me a gauge for how they're working, how the overall leadership in the market is acting, as well as the things that we still own. And that's how we approached today. Didn't buy anything, held on to our 4 longs, and got rid of our short on the Hexa. I took that from horse racing. You know how they have the what do they call it? The trifecta, the hexafecta is what I called it. Anyway, that's going to wrap it. As always, would love it if you'd reach out with any comments, questions, or complaints. Don at revereasset.com. The phone is 855-REAL-WEALTH. So finishing up the last day of August, it's been an ugly month for the indexes. We were down, let's take a look here, what the S&P was down, I think about 4.5% maybe. Down 4.24%. We were down about 0.5% for the month. So we had some good alpha. Leaders acted well. We got in early on the cross above the 21-day moving average, rode it higher, took our stops kicked in this week. We're out of that now. So let's see what September brings us, which, as we know, is historically the worst month of the year for stocks. Wonderful. So that's going to wrap it. The end of August, wrapping up August 31st. This is Don Vandenbord reminding you, it's not how much you make, it's how much you keep. Don't get punked by the market because you don't have a sell discipline, or if you have friends or family that are worried, have them give us a shout. We'll discuss how we approach the market with them. They don't have to, especially if they have just a pie chart salesman advisor not watching their downside. As I said, it's not how much you make, how much you keep. So this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.